Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest high-energy updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon, 7 p.m. Eastern Standard Time. Here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Ladies and gentlemen, what if I told you that owning what many people consider a small amount of XRP might already place you ahead of the vast majority of holders on Earth? Not top half, not top quarter, but potentially within the top few percent globally. At first, that sounds impossible. After all, crypto feels crowded, right? Social media is filled with charts, predictions, and endless debates about which digital asset will dominate the future. But hidden behind all the noise, there's a data set most investors never look at, the XRP rich list. And when you zoom out and analyze the numbers carefully, something surprisingly appears. The distribution of XRP ownership is far rarer than most people realize, which raises a fascinating question. How much XRP would someone actually need to be in the top 1% of holders in the entire planet? Ladies and gentlemen, I just want to stop and thank everyone that takes the time to like, subscribe, and share our videos and comments. These things really do help out the channel a lot, and I love reading everyone's comments. And if you're new here, please do subscribe because everyone's come to love the rants at the end of the video. And what might that reveal about where we truly are in the global adoption cycle? Because the answer isn't just about numbers. It may also tell us something about one of the most important technological shifts happening quietly beneath the surface of the financial world. The pattern of every technological revolution. Before we even talk about XRP, let's zoom out, because every major technological shift in history tends to follow a very similar pattern. In the early 1990s, the internet looked like a niche experiment. Most businesses didn't see the point. A website seemed unnecessary. Email was considered a novelty. Fast forward a decade, and suddenly the entire global economy was being reshaped by digital connectivity. But here's the important part. During those early years, very few people realized how early they actually were. The same thing happened with smartphones. The same thing happened with cloud computing. In many ways, the same dynamic may be unfolding today with digital financial infrastructure. But here's where things get interesting. When analysts examine the XRP ecosystem, they notice a pattern that looks remarkably similar to the early stages of other technologies. The dataset most people ignore. Most investors measure progress by watching price charts. Green candles mean excitement, red candles mean fear and disappointment. But price is emotional. Ownership data tells a different story. One of the most revealing data sets in the XRP ecosystem is something called the rich list. It's simply a ranking of wallets based on how much XRP they hold. At first glance, it looks boring, just numbers, wallet addresses, balances. But when you step back and analyze it, it becomes something else entirely. It becomes a map of global ownership. And that map reveals something that surprises almost everyone who studies it carefully: the wallet count illusion. Right now, there are roughly 6 to 7 million XRP wallets in existence. For many newcomers, that number sounds enormous. 7 million participants feel like a crowded market. It can even create the feeling that the opportunity is already passed. But here's the detail most people overlook. Wallets are not the same thing as people. In fact, the difference is massive. Think about how crypto works in the real world. Most users interact through exchanges. Those exchanges hold enormous custodial wallets, containing funds for thousands or even millions of customers. At the same time, many individuals create multiple wallets for security reasons: cold storage, hardware wallets, backup wallets, old accounts they forgot about, and then there are tiny wallets holding fractions of XRP that were created during past hype cycles and never used again. When analysts filter out all that noise, the estimated number of meaningful XRP holders worldwide may only be around 1 to 2 million, out of a global population exceeding 8 billion. Let that sink in, ladies and gentlemen. It's massive. That would mean more than 99.9% of the world does not own XRP at all. Nothing. Suddenly, the adoption curve looks very different. Now, let's talk about percentiles. Now, this part is where the numbers become truly fascinating, ladies and gentlemen. When analysts break down the XRP risk list into tiers, they notice a steep distribution curve. At the bottom of the list, millions of wallets hold extremely small amounts, sometimes just a few tokens, sometimes less. These accounts make the ecosystem look large, but they don't represent major ownership. But as you move up the ladder, the number of wallets shrink rapidly. For example, holding a few hundred XRP already places someone above a large portion of smaller wallets. At around 2,000 XRP, you're approaching the top 10% of holders. Yes, just a few thousand tokens could already place someone ahead of most participants in the ecosystem. But here's where the story becomes even more surprising. The top 1% threshold, when analysts estimate the top tier of XRP ownership, the number suggests something remarkable. While the exact thresholds vary depending on how exchange wallets are counted, many estimates suggest that holding somewhere around 50,000 XRP may approach the top 1% territory. Now pause for a moment, because this number often surprises people. Some investors assume the top 1% must require millions of tokens, but the reality of distribution appears very different, and that leads to a deeper insight about adoption. The adoption curve most people miss. Here's something almost no one ever talks about. Your position in an ownership ranking can improve even if you never buy another token. How, you might be asking? Because adoption curves grow from the bottom. When new participants enter a network, they usually start small, a few tokens, maybe a few hundred, sometimes thousands. That means early holders can slowly climb in the percentile rankings over time, even without increasing their holdings. This phenomena has appeared in many technological ecosystems. Early adopters accumulate first. Later participants join gradually, and the ownership curve expands beneath them. But here's where things get really interesting and spicy. When analysts study the top of the XRP rich list, they notice something else happening: a large wallet mystery. The very top of the distribution curve, the balance becomes enormous. Some wallets hold tens of millions of XRP. Others hold hundreds of millions. Many of these addresses belong to exchanges, custodians, or institutional entities managing liquidity. But what's fascinating is how rarely these wallets move. Their balances remain relatively stable compared to the constant activity happening in smaller wallets, which raises an interesting question. Are these large holders behaving like traders or like infrastructure participants? And that question leads directly into a much bigger story unfolding across the global financial system: the tokenization shift. Now, this next part surprised many people when it began appearing in financial headlines. Some of the largest institutions in the world have started experimenting with blockchain technology. Asset managers, banks, international financial organizations. Companies like BlackRock have explored tokenized financial products. JP Morgan has developed blockchain-based settlement systems. The Bank for International Settlement has run experiments involving cross-border digital payments. And SWIFT, the global banking messaging network, has tested ways traditional finance could interact with blockchain systems. These experiments are all exploring the same underlying concept: tokenization. What tokenization could change? Imagine a world where financial assets exist as digital tokens, bonds, real estate, funds, commodities. Instead of settling transactions in days, they could settle in seconds. Instead of multiple intermediaries, transactions could move across digital networks instantly. The idea is still evolving, but many institutions are actively studying it. And if tokenized assets begin moving across multiple blockchain networks, these networks will need ways to communicate. They will need liquidity bridges, fast settlement layers, deep liquidity pools. Supporters of XRP often point out that the network was originally designed with cross-border settlement in mind. Whether that vision ultimately plays out remains uncertain, but the broader infrastructure conversation is clearly growing. But here's the real twist. Most investors expect revolutions to look exciting from the beginning. They expect massive price movements, headlines, viral moments. But infrastructure rarely works that way. Think about fiber optic networks in the early internet era. For years, companies quietly laid cables across continents and oceans. Very few people paid attention. Then suddenly, the digital economy exploded on top of the infrastructure. The same pattern has repeated throughout history. Infrastructure builds quietly, then adoption accelerates later. Supply, demand, and flow. That brings us back to an important market concept: supply versus demand. Most investors focus on demand, but supply, specifically liquid supply, is equally important. In markets, analysts often talk about something called public float. This is the portion of an asset that's actively available for trading. If large amounts move into long-term custody for institutional reserves, the liquid float shrinks. And when floats shrink, markets can become more sensitive to increase in demand. This dynamic exists in stocks, commodities, and digital assets alike. Watching structure instead of price. This is why some analysts prefer watching distribution patterns instead of daily price charts. Price reflects emotions. Ownership distribution reflects positioning. When smaller wallets fluctuate while larger wallets remain stable, it can indicate long-term holding behavior. Of course, interpretation requires caution, but these patterns offer a different lens on market structure. And right now, many observers are paying close attention to how XRP ownership continues to evolve. The psychology of being early. There's another dimension to the conversation. Human psychology. Early adoption rarely feels comfortable. In fact, it often feels boring, slow, uncertain. During the early days of the internet, many investors ignored the sector entirely. During the early years of smartphones, few people predicted how dominant the world would become. Technological revolutions rarely look obvious in the beginning. They look experimental, messy, incomplete. Only in hindsight do they appear inevitable. So, what do we actually learned here? First, the XRP rich list reveals that ownership distribution is far rarer than most people assume. Second, the number of meaningful holders globally may still be relatively small compared to the world population. Third, percentile rankings can shift over time as new participants enter the ecosystem. And finally, the broader financial world is beginning to explore digital settlement infrastructure in ways that could reshape how assets move globally. None of this guarantees outcomes, but it does provide context. And perhaps the most interesting takeaway isn't about price, it's about positioning. Because in many technological revolutions, the earliest participants rarely realize how truly early they are. So here's a question I want to leave with you. When you look at your position in the XRP ecosystem, do you measure it by price or by where you sit on the ownership curve? Because history shows that sometimes the quietest phases of innovation are happening long before the rest of the world notices. What do you think? How much XRP do you believe will define the top 1% in the future? Let me know in your thoughts in the comments below. Well, ladies and gentlemen, a lot of exciting things happening today. And if you made it this far, I salute you. Today, we're going to talk about a couple things that are super important. And I'm going to introduce a term we're going to go over, that Operation Printed to Win It is going to begin a lot sooner than most people understand and believe. And when Operation Printed to Win It begins, a lot of things are going to take off. But first, I want to welcome all the new members of the Patreon, all the new members of the membership channel. It's really nice to meet and chat with everybody. And I hope everybody is getting the Gucci conviction and clarity for what's coming. But I want to be very clear about something. Right now, the global market is operating under a massive illusion. On the surface, everything looks fine. The S&P 500 is near highs. Retail investors are pouring record money into ETFs. AI stocks are still dominating headlines. But underneath the surface, the foundations of the financial system are starting to crack. We're seeing credit markets deteriorating, private credit funds facing redemption pressure, banks quietly marking down collateral, geopolitical shocks in energy markets, and a central banking policy mistake forming in Europe. And when all of these things start happening at the same time, history tells us something very important, ladies and gentlemen, and you got to let this marinate and sink in. This is a very important rant that I'm going through again, and we're going to get to the next item that we're focusing on to create alpha. Everybody else has heard about the other ones that we're taking advantage of, but this one's coming next, so stay with me. But again, this is super important. I need everybody here to get that Gucci clarity and conviction. Why we pack up is to understand where we're going for survival. People are getting caught up like sushi, but there's also a whole nother group of people that are prospering. None of this is financial advice. Again, none of this is financial advice. None. And if you're still here, I appreciate a like. Ladies and gentlemen, we're entering the late stage of the cycle. So today, I'm going to walk you through the real macro picture of 2026. You're not going to hear this anywhere else, but anyone who retains any capacity, I've been saying this nonstop. Not the retail narrative, not the CNBC headlines, but the institutional reality, because the smart money is already shifting strategy. If you don't understand what's happening now, you're already going to be positioned completely wrong for what comes next. The AI boom is real, but the market's priced in already. Let's start with the biggest narrative dominating markets right now, artificial intelligence. Here's the most important thing. The AI bull case is real. We are witnessing one of the largest infrastructure investment cycles in modern history and in our lifetimes. Telecom companies are upgrading networks. Cloud providers are expanding compute capacity. And companies like AT&T alone are discussing hundreds of billions in network upgrades to support what many are calling an agentic economy. An economy where AI systems operate autonomously and require massive compute infrastructure. So yes, the spending is real. The demand is real. But here's where the market is starting to change. because something extremely unusual is happening with AI stocks. Take NVIDIA as the perfect example. They have delivered 8 consecutive quarters of extraordinary earnings beats. 8. In almost any other period in market history, that kind of performance would send the stock market parabolic. But instead, the stock has largely stalled. There's other geopolitical reasons of why, but when a company delivers incredible results, but the stock stops rising, the market's telling you something. It's telling you that the growth is already priced in. This is what institutional investors call valuation decoupling. This is very important. Valuation decoupling. The fundamentals are still strong, but the upside from here requires something different. It requires the market to believe in an even higher terminal value for the industry. And right now, the terminal value is an open question, which is why many institutions are quietly shifting away from chasing AI hardware stocks, because the real profits in AI may no longer come from shelling the shovels. They may come from the users who shovel the best, meaning the software layer, the application layer, the companies that actually monetize the compute. That shift is just beginning. But now I want to get to what's very, very important. Why I want the AI is so important, ladies and gentlemen, because that was a bellwether for risk on, risk off. When that went through the roof, crypto went through the roof. So I want you to put that and write that on the board about one reasons about why things have cooled off in a minute. And again, this is very important. I want to touch on the energy market, which is a geopolitical powder keg. Let's talk about the second major force shaping markets right now, energy. Yesterday, we talked about Iran laying mines in the Strait, because the oil market is currently experiencing one of the most confusing price environments in decades. You have massive geopolitical risk, you have shipping lane tensions, you have threats involving the mining of major trade routes, and historically, even rumors of something like that would send oil prices exploding higher. But that hasn't happened, and that tells us something extremely important. The United States government is actively suppressing the right tail of energy prices. Why? Because sustained oil spikes would create political chaos, higher inflation, higher transportation costs, higher food prices. So every time oil starts to rally aggressively, you see the same playbook. Strategic reserve release, talk, diplomatic pressure, coordination through the International Energy Agency. So in other words, governments are trying to cap the ceiling of oil prices. But here's the problem. It's massive. Even if they cap the spikes, they cannot eliminate the structural risks in supply chains. Things like shipping disruptions, insurance costs for cargo, geopolitical tension in trade corridors. Lloyd of London, again, they're doing insurance. That's going again right now, which means the equilibrium price of energy is rising if governments try to suppress volatility. And that has massive consequences because energy inflation doesn't stay in energy markets. Energy is very efficient, very, very efficient market. It spreads into transportation, manufacturing, agriculture. Ladies and gentlemen, that is why we're taking advantage of every one of these sectors. Again, if you want to see how we're taking advantage of every one of these sectors, do join the Crypto Republic Trading Monthly Desk. We're helping people every day take advantage of all the things that people retain at any capacity to. We're showing them how to do it day by day. And if you want to make a difference for yourself, do come and join us. One tip from the pit will pay for the entire year. But this is going to bring us to the next overlooked risk. Remember, we went over LNG. We went over sulfur. You've heard this here first from us because, again, I don't even think that we're a regular crypto channel anymore. Everybody wants us to do rants right now. We might be just transitioning to that. But again, I love all of you. I love being here with everybody, and I love explaining things because you make a living by what you make, but a life by what you give to other people. Write this down. The food inflation nobody is watching. This is the next place to make alpha. While everyone is obsessing over oil, very few people are paying attention to agriculture. I love ags. They should be because food inflation tends to behave very differently from other forms of inflation. Once it starts rising, it becomes extremely sticky. Why? Because modern agriculture is one of the most energy-dependent industries on Earth. Write that down. Fertilizers require natural gas. Farming equipment requires diesel. Transportation requires fuel. Processing requires electricity. So when the energy costs rise, food costs eventually follow. And the data we are seeing in agricultural commodities, it's crazy right now. We've been following soybeans. I love soybeans, again, especially soybeans, suggesting that this trend is quietly building in the background. This is what economists call pipeline inflation. Input costs rise first. Then months later, those costs show up in consumer prices. And when they do, central banks suddenly realize the problem is much harder to control than they thought. Holy Moses. The credit market is flashing red. Now we get to the most important piece of the puzzle, the credit. And ladies and gentlemen, if you want to see how we're going to take advantage of the agriculture plays right now, come and join us in the Crypto Republic Trading Desk. You're all welcome to make a better impact on your trading situation and learn. Ladies and gentlemen, every major financial crisis in modern history begins not in equities, but in credit markets. And right now we are seeing several warning signs that institutions are watching very closely. First, private credit funds. One of the largest funds in the space is expecting over 7% redemption requests. Now, that may not sound huge, but in private credit, that's a very big deal because those loans fund invest in illiquid loans. When investors want their money back, the fund can't easily sell the underlying asset. So what happens? They start selling their most liquid position first. This is textbook. So for a lot of people asking us questions about this, rewind that, what I just said. You're going to learn a lot from that, which leaves the fund increasingly filled with the least liquid loans. This creates a dangerous cycle. Liquidity disappears, redemptions increase, and eventually funds begin something called gating. Gating means limiting investors' withdrawals. And historically, once gating begins in one part of the financial system, it spreads. But that's not the only warning sign, ladies and gentlemen. It's not. I mean, beet juice. We're also seeing cracks in consumer credit. Canadian subprime lender recently saw its stock collapse over 15% after warning about rising loan defaults. That is a major signal because subprime borrowers are the first group to break when economic conditions tighten. But the biggest warning came from the banking system itself. JP Morgan recently began marking down the value of loans it used as collateral in financing facilities. That is extremely important because when banks start applying haircuts to collateral, it means they are becoming less willing to lend. And when lending tightens, liquidity disappears. This is how credit cycles unwind, slowly at first, then suddenly. Ladies and gentlemen, Europe may be walking into a policy disaster. Now, I want to talk about Europe for a second. Again, I'm going over a lot of things. If you're new here, please do like and subscribe. If you want to see how this turns into profitable trades, do come and check us out in the Patreon. These cycles play themselves over and over and over again. When you know what's going to happen, you find it almost impossible not to get cut up like sushi. None of this is financial advice, just my professional opinion, anyone that retains any capacity. I want to talk about Europe because the European Central Bank may be making a massive policy mistake. Several ECB officials have signaled their further interest rate tightening is possible, if you could believe that. The problem, the inflation Europe is overwhelmingly experiencing is largely energy-driven, and rising interest rates does absolutely nothing to solve an energy supply shock. Instead, it does something else. Unfortunately, it crushes the consumer. It does crush the consumer. Europe already has higher energy dependence, weaker growth, fragile consumer demand. So if the ECB tightens monetary policy under energy shock, they create what economists call a double squeeze. Higher energy bills, higher borrowing costs, and at the same time, that combination has historically produced self-inflicted recessions. It's really bad, which is why many institutional investors are currently underweight European equities. The upside is limited, but the downside risk is very, very real. So here's the most fascinating part of this entire situation, at least to me. I find this fascinating because being a financial mercenary, again, myself and the people that retain us any capacity in our organization, we don't care what happens. We care about green trades, our bank accounts growing, and from point A to point B safely. But here's what fascinates me the most. Retail investors are doing the exact opposite of what institutions are doing. Retail investors are buying the dip aggressively. ETF inflows are near record levels. That's something very, very big. Now, look, I want to go over a couple factoids. I'm going to lump all this in. Again, ladies and gentlemen, the world is now being driven by tweets, social media craziness. I never thought I could ever see it in my lifetime. I used to think the COT page was always manipulated, right? Trading places, orange juice. But tweets can shape the whole market now. These next two facts are very important, also for XRP. The Malaysian International Reserve rose to 128.3 billion at the end of February. The gold reserves, the highest level in more than 11 years, supported by gains in foreign exchange holdings and higher gold reserves, according to Bank Negara Malaysia. It's massive. The Czech National Bank increased its gold reserves by 4.5 tons since January, lifting total holdings to 16.5 tons and making the country's highest level since 1998 as officials continue rebuilding bullion positions with foreign exchange reserves. That accumulation for them reflects a sustained shift in reserve micromanagement strategy after decades of declining holdings. I want to touch on something, right, before I give you the crypto breakdowns. I believe XRP is going to go a lot higher. I've been telling this everyone over the phone. If you made it this point, you get the candy from the Italian ice. Ladies and gentlemen, there's 11 monster ETFs, monsters, sucking up supply. If you look at the liquidity on exchanges, it's extremely low. You put those together and a couple turn of events, you could see a supply shock. So as far as I'm concerned, going much higher. And I'm excited about the prospects of it. Again, because the things I'm outlaying and why right now are massive, massive. And these other things as well are massive. Because if you realize that all the markets right now are in a state of flux, this is when the biggest opportunities are to be had, when the market's in a state of flux. So being able to take advantage of any capacity that you can at any level that you can that makes sense to your personal situation is very, very important. I'm going to get to this in one more second, but I want to go over this. The U.S. Justice Department is investigating whether Binance was used by Iran to evade U.S. sanctions related to over USD $1 billion in transactions alleged funding Iranian-backed groups. The probe follows Binance's previous internal inquiry and involves U.S. Treasury scrutiny and related Senate investigations. You know, Iran had bought $500 million worth of Tether. We had gone over that in a bunch of other videos in the past. The CFTC chairman, Mike Selig, said the U.S. is reclaiming crypto regulation leadership with a joint SEC initiative and new guidelines for DeFi, prediction markets, and AI-driven trading. The CFTC will clarify registration with DeFi providers, update rules for leverage, crypto spot trading, and assert authority over event contracts and perpetual derivatives. Big. The UK government's Home Office described digital assets as a growing risk in 2026-2029 fraud strategy, noting scams using digital assets. Policy outlines enhanced investigative resources. So that's very, very big. U.S. federal prosecutors seek forfeiture of USD 3.44 million and USDT alleged link to a crypto investment scam that targeted multiple states. Authorities seized the funds in February and March 2025 after victims sent ETH through fake investment opportunities, later converted to USDTC. Societe Generale Forge, a digital asset arm of Societe Generale, has expanded euro-backed stablecoin EUR convertible verbal EURCV to the Stellar blockchain broadened regular digital asset infrastructure. Again, there's a lot of things happening. This is important. U.S. senators are negotiating compromise and stablecoin rewards to advance the Stalled Crypto Clarity Act, addressing industry and banking concerns over deposit flight. The compromise could limit rewards to transaction-based activities, with many legislative steps and unresolved debates remaining before the bill could reach a Senate vote. Ladies and gentlemen, everything I just went over is today's world for you. Now, you can either be really disappointed about all this or take advantage. Because again, when Operation Printed to Win It begins, and it's starting, we're gonna look back at these prices. We're gonna look back at these and say, "Wow, I could have gotten more. Wow, I should have gotten this. I shouldn't have gone out to dinner. I should have bought more and more and more." Ladies and gentlemen, as the remora, we are feasting on the carcass of chaos. We went over in the last video. If you're new here, you're gonna have to go back and listen to the ends of the video if you want to hear the rants about what's moving the oil market, what's moving the gold market and silver market, what we're playing and what we're taking advantage of for people. And none of this is financial advice. It's just my own opinion. So when you look at this, right, no matter what goes on right now, the breakdown of supply for items used in food is going to be felt in prices. And if you understand how to handicap this, it's raining alpha. I've been doing this half my life. And if you want to see how to do this, come and join the Patreon. You'll see. But again, we're going to take advantage of that because everything else is old news. Oil is old news. Silver is old news. Gold is old news. LNG is old news. We even talked about sulfur, old news. Nickel, old news. Copper, old news. Because everybody's playing them already. And you have to be first in, first move with that. Again, because those are trades, you're in and out. When you look at crypto, how we approach crypto, if any retains any capacities, we stress long-term accumulation. Long-term accumulation, no different than when we are buying concessions, whether that be for metals, for fossil fuels. When we buy concessions, it's long-term because we own what's in the ground and we want to control the distribution, how it's going to be consumed further downstream. Again, we're so early with what's going to happen. I know people don't want to hear this, right? And it's taking me time. And thank you for everyone explaining to me what the domino theory is if you're still here. But again, we're going to look back at these moments and people are going to say, I wish I would have gotten more right now, because these are rock bottom prices. And when Operation Print to Win It begins and it's starting, they're going to inflate the price of assets because the political party that's in power is going to want to stay in power. You can see the writing on the walls here. And ladies and gentlemen, when you look at what the United States wants to become with the crypto world, the crypto capital of the world, that's for all crypto. So if you're going to front one the crypto market, don't even be in this market. If you're going to cry on down days, then why are you in this? Most people, the calls I get with people, I always ask people, one of the most important things I ask, why are you involved in the crypto market? I want to know. And I'm quiet. I want to take notes. Why are you involved? Tell me. Because I don't think the price is going to move when they pass some Clarity Act, because it takes time for people to allocate money. But that opens the floodgates, opens the gates. There's nothing holding it back. Nothing. So answer me this. Why are you involved in the crypto market? It's not some get-rich-quick scheme. It's an asset. You can see around the world, regulations matter. Licenses matter. The tokens and coins that have these things matter. The ones that don't have it, I don't think matter very much. I'm not going to have a philosophical debate about this, but, you know, the amazing thing about true investing on the institutional level is the philosophical debate is not through Twitter. It's not through YouTube. It's through performance. It's through client retention. It's about making alpha for the people that retain us. It's not about making videos and saying, I told you I was right. I don't like you. You're wrong. This, that. It's about making sure everybody made money. Making money. That's why I've been doing this half my life with all of us. Day in, day out, following a strict code of being a financial mercenary. Because it works. You don't reinvent the wheel. What you do today prospers for you tomorrow. If you're looking for something to moon overnight, you might as well play meme coins. And all the people that hate, I love my haters. Hate on me some more, right? And I'm not AI. If you think I'm AI, God bless you. And all my haters and everyone hating on you, keep doing it because I'm going to come with the love. Because the world's going to change. And we're going to look back at this video. I'm going to write down the name of this video, the XRP Rich List, right? Talking about when Operation Print to Win It began, and it's beginning now. Again, if you want to know why, come and join us in the Patreon, and you will understand why. Because I can't give that away for free. I just can't. But you know what? This is your time. This is it. You can go back to what we thought in the 90s when you first saw the internet coming. I can give you a million reasons of why. But for everyone who's taken the leap of faith, you don't need to share anything about why you're doing or why you're not doing it. But again, what I believe for XRP, and XRP is the chosen one, as far as I'm concerned, I believe in infrastructure. XRP is the chosen one as far as we're concerned for infrastructure for finance. ICP, again, the chosen one for a lot of different things. Look at ICP's massive move. Anybody who's been listening to me rant and rave about ICP, I salute you. You just made like 40%, 30, 40%. We're telling people they just listed it in Korea. Went to the roof. I love that. To me, I love that. That's the greatest candle ever. But it's happening. You need infrastructure for everything. You can, I don't like this coin. This happened to me then. This happened to me this. Are you allergic to doing well for yourself? Tell me. Really? How can you be allergic to getting ahead for yourself? None of this financial advice. But again, HBAR, ICP, XRP. Look, there's not enough XRP in exchanges. As far as I'm concerned, XRP is going this way, baby. And people are going to look back and say, my God, I wish I would have taken more. I wish I had more time to get more. The future's coming, ladies and gentlemen. Again, we wrote a whole piece about this. The future's here. Operation Print to Win It's coming. Will you be ready? I'll see you all on the Patreon. I love everybody. This content is for informational and entertainment purposes only. It should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling them something that'll happen again, Or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the other ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. You move now, be remembered. This is not the end of the story. This is just the beginning. This opened your eyes, smash that like button, ring the bell, leave a comment with your thoughts, turn on notifications, and most importantly, subscribe to the Crypto Republic, where we break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the Republic. I love you all.